Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted on this occasion to be joined by Aline Carnizelo, the managing partner at Frontier Commodities, sitting in the beautiful mountains of Switzerland, to take this opportunity to take a slightly deeper dive into some of the dynamics that the Gulf War and the disruption of the Strait of Hormuz is having across the commodity complex. So, Aline, thank you for taking the time with us today.
Hello, Sean. Thank you for having me. Pleasure being here.
Thank you. Let's start off with sort of a big picture thing. We're now 70 plus days of the Iran-Israel war the U.S.-Israel war in Iran and Iran's retaliation against the whole region. And with that, the Strait of Hormuz being disrupted to closed for many, many weeks now. We've just coming out of a weekend in which there was expectations of maybe some kind of an agreement between the US and Iran, but still seems elusive. How do you assess the overarching picture now, 70 days moving to 80, 90 days without any end in sight, from the commodities markets as a whole? How do you assess the situation?
Yeah, so the situation is getting because the disruption is so large on a daily basis that is getting exponentially problematic. When we started this war, we were in a period that it was the shoulder season for demand on oil and oil products that is in between, winter and the driving season. And then we came into refinery maintenance. So it hasn't been the peak demand season that we have been facing in March and April. Now coming in May, we start to hit, not only all of the buffers are gone, but we start hitting peak demand timeline. So both from supply and demand, we're getting exponentially worse on the disruption that we're seeing on the ground. And we haven't felt really on the stock markets. Obviously, Southeast Asia, and it's very kind of regionally, the disruption is very, there's a huge disparity in terms of the amount of disruption that you're seeing regionally.
The physical disruption, the supply on the street, so to speak.
Exactly. So if you go to Bangladesh, I'm sure people are feeling much more than in West Texas, this disruption. But overall, globally, the buffers between the release of the SPRs and being not in that summer season that it is really where high demand hits, gave us a buffer. And also, I think the market doesn't really perceive the timelines. It takes about 4 weeks for the shipments to come out of the Strait of Hormuz to go to the end market. So we actually have not had deliveries for about 4 weeks. So at the beginning, people were feeling, it's not so bad. It's not so bad because the shipments are gone. It takes a timeline. So I think overall, now we are in a situation where we came off from a very large buffer inventory that we had last year, both oil on water and oil on land. We practically eat up to almost entirely this buffer. And now we're going to summer driving season with SPRs getting to very close to very low levels. And we see the inventory is going to hit very low levels. So I think every day from here that the war continues and the strait is not open, is getting a bit of an exponential, impact back into, let's call it, if this is not solved by June, it will be a very, very large issue. And by releasing the SPR and by the countries, basically supporting the consumption of oil, what you're not having, apart from, again, regionally, Southeast Asia is suffering and demand you can see visibly down there. But the rest of the world, the demand is not adjusting to the shock because the SPR is being released, right? So it's almost like...
So we're not really seeing demand destruction in the developed markets while we're seeing...
Correct. You see it in Southeast Asia just because it doesn't have supply, right? So
or it can't afford to compete for the higher price.
Exactly. Where you cannot afford to compete for the higher price, you're seeing that demand destruction. But releasing such a dramatic amount of SPR to buffer this. What is happening is that we are not getting the consumption reaction in the developed markets that you would have got otherwise. So what it does is that it's actually tighten the market much faster by protecting the consumer in the short term. So what I think is like, it's like you extended the elastic, you're pushing down, pushing down, pushing down. And once it breaks, it will break much higher because you're not seeing the adjustments today. And there's also, in my opinion, a very weird perception from the market, particularly if you go like here in Europe, we are very conservative, we are very exposed to this war. So people tend to be more into like the realities on the ground. But in the US, when you talk particularly with portfolio managers, people think that, let's say, you make a deal and the Strait of Hormuz is completely open, and the next day, and oil production in the Middle East is back to where it was 3 days after. And we know that the reality on the ground, first, is extremely complicated to make this deal, right? There are various, incentives into place. Definitely the incentive of Iran is to drag it longer. It has the buffer time to do it. He knows that the longer it drags, the more powerful it becomes. Second, even when the deal is made, there's a lot of logistics issues that I think the overall market are taken for granted. So, for example, if Iran decides to charge some kind of fee for the fleet that goes into the Strait of Hormuz once it's open, who will be able to pay a fee to a sanctioned country?
Well, you'd have to assume at that point that any deal that's done would be removing that legal definition. If you just look back on the point you made there about the drawdown of the reserves, the strategic reserves, the IEA release of 400 million barrels of members' reserves. What impact does that have in the sort of mid to longer term on oil price? I mean, as you deplete the reserves, ultimately it seems if you don't have demand destruction, you're setting yourself up for a longer period of a higher oil price, because even with the Strait reopening, you're still going to have the demand, the stress for lower reserves. I'm just wondering, what's your outlook for the impact of this buffeting the problem on the short term, but does that set you up for a longer term higher oil price?
Yes, so I absolutely agree. And it's exactly what we like here as a trade, not to get to technical things, but the future price of oil right now, the oil curve is basically very backwardated. One is because the spot is tight, so it tends to trade higher than the future price of oil. But the other is the expectation, again, going back to this view that the Strait will open and everything will be fine in 2 weeks, right? Our view here is much more refined and a lot more conservative, because one, turning back on the assets will be a decision that will be made not immediately after the Strait is open. So that's very important, right? It will be made when people feel safe enough to turn back that asset. And every time that we have this back and forth, we say we have, we can pass, and then, our vessel gets shut down. It's creating longer time, a period for people to feel comfortable, because we've been back and forth quite a bit, right? So when
it's like the Rumaila oil field in Iraq, it has 5,000 wells. They're not going to try turn them back on unless there's some certainty.
Exactly. So a minimum, I'd say 1 month, right? That the Strait is working really well, everything's going for them to turn it back on. And turning back on is really, really expensive. So that's one thing that impacts here, right? Because it's not going to be turned back on immediately. And then you have different categories of oil assets ramping up at different times. So some of the Saudi production can be ramped up quite quickly, 2 to 3 weeks, they ramp up. Others, like Bahrain, assets that are, much older, will take 3 months to do it. So, you open the Strait, then you have at least, in my opinion, minimum 1 month for them to decide to turn back on reasonably, right? And from there, you then have the timeline to reach production. On top of that, it is extremely inflationary, right? Insurance costs will never come back to where it was before this war. We talked to the physical operators, and they're saying that if when we settle, it's going to be 8 times higher on insurance costs. is there going to be a tariff or not on Iran? Is Iran going to be unsanctioned to pay so that Western companies can pay that tariff? What is the timeline between Iran is sanctioned to, the compliance department of
Exactly.
ExxonMobil allowing Exxon to pay this payment? There will be a timeline there as well, physically, right? And all of it will become much more inflation.
What about now? I mean, in the interim, this is ongoing. The Strait of Hormuz only seems, the constants. Oh, well, 2 weeks. Oh, it'll be open. Oh, yeah, just another 2 weeks. Oh, yeah, just next weekend. It's like this constant. Then you'd have to say Trump and his people have managed that quite well. The short horizon expectation has kept the front man quite under control. I'm wondering from a trading point of view right now, we're hearing that a lot of physical traders are staying out of the market because of the unpredictability of the headline driven up or down $10 depending on a headline. Where are the paper traders? How do you see the market at the moment as in terms of is it tradable while this goes on? Not looking beyond the reopening of the Hormuz, but in this current window now that we've sort of settled into this period.
Absolutely. I think it's extremely tradable, and it's probably the greatest opportunity that we have here in commodities is oil and the byproducts. We can go into the products as well. That is even tighter than the Brent itself. But for example, Frontier, a bit technical here, but we trade at 10 vol. So we have control volatility strategy on commodities. So I cannot be in the front month of the oil because indeed that is a little bit going to the casino, right? Like Trump sends a tweet and then suddenly the price is now down $10. But the oil December 26 and the oil December 27 has half of the volatility and is a much lower price. So if I look in here, the spot market is 103 and December 26, which actually settles around October, it's at 88. So first, I got a great opportunity because if oil prices stay flat, what happens is that this contract goes slowly to the spot price. So I have 20% return if the oil price stays flat. And the second thing is this contract is half of the volatility of this one. So it's a much more tradable contract that people are looking much more into the supply and demand and what is going to be the impact in the middle term than the front month, where it's really like a little bit of a casino there. It's difficult to trade in the front month. But I think there are a lot of opportunities in the back of the curve and a lot of opportunities in what we call cracks. So differentiating between the middle distillates and the products and the Brent, because refinery margins are at all-time highs. Refinery capacity is very tight outside of the world. And, the Strait of Hormuz had a lot of products as well that are important, not only for, directly oil, but also agriculture, nickel production. So it is across the board a disruption that will impact supply chain, right? The difference between...
And are those other markets as similarly volatile as the liquids market? Or is there a different reaction there?
Yeah, the product markets is extremely volatile, even more, I would say. The second impact that I mentioned, for example, sulfur is a product that comes out of the Middle East. Sulfur is essential to produce nickel. In Indonesia, we have nickel HPAL facilities that require sulfur, comes majority from the Middle East. So you already see nickel production shutting down quite a bit in Indonesia for like a sulfuric acid. That trade is less volatile. The second order of impact so far has been less volatile. The product side of things, which will be more diesel, gas oil, that is very volatile at the moment. But we see quite a bit of that's the difference between an oil shock and a copper shock, let's say. The oil shock impacts the entire commodity supply chain because one, it makes everything more expensive because oil and products is such an important component of the cost curve of producing everything else. And the second is when you have shortages, then you start ballooning in an escalation way, the disruption, start disrupting nickel, you start disrupting a bit of the copper production in Congo, you start seeing problems with fertilizers that might impact the crop in December. So it is
And
a
when you
little
look at the, as you said there about the reopening of the Strait of Hormuz, we talked about that it would take time for field production in oil to restart for different reasons, logistics. What about on these other products, sulfur or fertilizer, nitrogen, the helium, etc., these other products that are so critical for the world economy? Do they get moving quicker than the oil, do you think, or how do you see any difference there?
It's the same, it's similar. Yeah, all these productions are very technical productions. They're not easy to operate assets. So it takes time. You have a little bit of a buffer because you have about 500 vessels that are restrained in the Strait of Hormuz. So in the immediate short term, what you're going to have? You're going to have a release from those vessels that are there coming to the market. And then you're going to have a window that will be again, that my prediction is you release the vessels, people think, okay, everything is fine and is down. And 1 month afterwards, you realize that it's not fine. You just like release those vessels that are there, but the production is still taking quite a bit of time and you consume a lot of the buffer. So those vessels can go, the ones that are in there, but the production will take time for products as well.
When you look at this period from the point of view of this major disruption that has happened and is still ongoing, obviously, it's also come at a time when we've had the arrival or the sort of merging, or certainly the arrival of the sort of hedge funds, the paper trading, moving more into the physical universe. Has that accelerated? Has that just been a coincidence, or how has that played out as you and your peer group have emerged over recent years more into the physical space? Has this been a moment of arrival? Has it accelerated that change, or how do you see the impact on that?
So I think it is more of a coincidence than and I don't think this is driven by the hedge funds and going to the physical markets. It's more of a move that these are people really looking for uncorrelated returns. There is a huge concentration. I think it's more a consequence of the concentration that we have on returns on the equity capital markets that are at historical highs. So you have these 7 large equities that is driving 70% of the returns of the stock market. That is the worry of these hedge funds that try to provide uncorrelated returns, right? So by going physical, there are 2 things, right, that I think it makes sense. One is this concentration that they're trying to stay, a little bit more diversified sorts of returns. And the other one is just the amount of commodities per unit of GDP in the world is increasing quite significantly. So about 5 years ago, we were very much a service-centric economy, right? The amount of commodities you need for the unit of GDP was very small. And it started turning about 3 years ago. And there are a few factors for that. One is simply capex cycle. So the grid system in Europe and in the US is about 42 years old. It needs to be replaced to keep the lights on. It's not even an AI trade. Then you have the AI trade on top. Then you have militarization coming that is taking a huge amount of commodities. Nobody's talking much about it, but
Any particular ones?
There are specialty metals that are very triggered by this. So tungsten prices, as an example, has tripled recently because they are very hardened materials that is necessary for tanks and all of that. That is like really squeezed into this market. But overall, you see steel demand, performing much better than the analysts have forecasted. And on the back of that, there is the revitalization team. And here in Europe, you had the largest fiscal plan of Germany in the past 30 years. We almost forgot about that, but it's going on the ground because it's
trillion euros.
Exactly. There's so much headlines that we forgot about that, but it's also very commodity intensive. So it makes sense as the economy becomes more commodity intensive that those hedge funds will looking to get exposure to that, right? So from a diversification perspective and from an economic perspective.
And you see how much money the trading firms are making, the physical traders. Exactly. They've made fortunes in recent years.
Absolutely fortunes. They're doing quite well. from this dislocation. So on average, and the third thing is that this dislocations and disturbances in the supply chain. When I started doing this, we track quite a bit in a high frequency indicators, the supply and demand on every commodity that we trade. So we have images of every vessel in the sea, we have heat images to forecast how much is being produced on each asset and all of that. When I built the systems, we used to have one or two main kind of disruption in supply chain. It could have been a hurricane, it could have been anything, right, that you usually have, and the system adapts. Right now we are categorizing like 10 to 12 major disruption in different commodities on a yearly basis, right? So these are very it's a source of uncorrelated returns for a strategy like ours, and that's why the hedge funds are coming into play. Geopolitical risks, climate change. It's an El Nino year this year, so there's so much in play here that you can do.
When we just
commodities
when we
position.
look to sort of go into our final thoughts, Aline, I wanted to get your sort of you were touching on it there, but just to focus it a bit around the legacy impacts or changes of this event that is yet to find its end, but ultimately we can start to see the legacies like in that particular heavy commodity usage. The idea of that we might be seeing the end of just-in-time delivery, which the world has been built on for the last few decades, and a lot more focus on inventory and storage and stock. Your thoughts on that and other types of legacy changes that this event will bring?
Absolutely. So you asked about the strategic stockpile, right? So these will distribute the higher oil prices, exactly as you mentioned, into the future. Because what is happening, the relief we're going today, we will have to replenish those stockpiles in the future. And not only that, but nobody's going to come out of this largest disruption to the oil supply chain in history and think that they had enough stockpile. Everybody's going to increase their own security set. So it's that trade-off between efficiency and resilience. The world is going to have to move into resilience, which means on a supply demand model, you're not going to be looking at, we're going to produce X amount of air conditioners, how much copper we're going to need. It's going to be, we're going to produce this amount of air conditioners in China, this amount in the US, this amount in Europe. We're going to have to stockpile this amount of copper in the US, this amount of copper in China, and this amount of copper in the US. So the overall inventory hoarding is going to be a major thematic, and it's not just for now, it's for the next 3 years. And it's already happening. And what is happening is that it's happening at a time that those commodities are not in a very high availability of inventory level. So what you could see is like this self-fulfilling prophecy of hoarding and pushing commodity prices higher, and it's going to be inflationary. The other final thought that I'll put here as a legacy impact is that take a look at the Red Sea. The Houthi attacks was about 2 years ago, right? Today, the volumes on the Red Sea are still 40% lower than they were before the attack. It wasn't a war, it was an attack, it was a much less complicated situation, and it was a long time ago. So just keep that in thought when we think about that we're going to reopen the Strait of Hormuz, and suddenly we're going to go back to full capacity.
I suppose the Bab el-Mandeb has an alternative, although a very long journey, but you can at least go around Africa.
Exactly.
In the Gulf, you can't really go around anywhere.
So it's going to be complicated for longer, is my prediction. And people will have to stockpile even more, and that will distribute the higher prices for longer. And here in commodities investing, it's a great opportunity to then take advantage of those backward data curves, make the yield that is given to us, because it's likely going to be higher for longer across the board in these commodities.
What about, I mean, speaking of legacy and history as a reference, after the 1970s energy crisis, we did see the creation of the IEA, OECD imposed this this rule of 90 days oil cover and built up a stockpile, which is now the inventory that's being used in this crisis. But it also delivered much higher driving miles per hour standards and more efficiency of oil and energy consumption, which lowered the per GDP capita use of hydrocarbons for economic growth. Would that be a feature here? A much greater
Yes.
use and acceleration of renewables or other types of, demand destruction? Although you're saying there's a lot of bullish outlook in the short to midterm, but it could also deliver a lot of demand destruction, perhaps.
Yes, absolutely. I think there are two things that we can think here. I think the renewables is a great call. Not just for that, it was before, like for this whole data centers and the squeeze that we're seeing in electricity. You're already seeing, for example, EVs this year in Europe is around up 30%. So people are trying to get isolated from these dependencies of external supply chains. So that will be one that is really, really strong. And I expect that to really accelerate as well. And also in terms of the grid level and the products, production becoming more efficient, as you said, and also more flexible. Look at Brazil, right? Brazil, you can use in your car ethanol or you can use gasoline. You immediately switch to sugar-based and corn-based ethanol without any difference on a week-by-week basis. So I would expect not only on the car, but overall industrial production to be thinking and being more creative about having the capacity of like substitution, something that China already built in quite a lot of resilience. You see gas prices, people had such a high expectation of gas, and it's actually not gone that high as people expected. Why? Because China has a lot of flexibility in switching for different, switching to coal power and, maintaining that production with different energy sources. So I expect two things. Yes, renewable will grow a lot, and we also be thinking much more about optionality into the system.
Last question, Aline, very local and immediate. We touched on it off air, but ultimately, the Dubai, Abu Dhabi has become a destination for a lot of you and your peer group moving resources here from Geneva and from London and so forth. How do you think this crisis will impact that momentum that we saw being very accelerated in the years after COVID?
I think it's very unfortunate. I think that what is happening to Dubai and Abu Dhabi that did such a great job of creating stable economies and an incredible place both from quality of living standards and business friendly. Will take time probably for us to see how much would it be impacted. From when I talk to peers that are based in those regions, there is a bit of a mixed feedback. Half of them are like, no, I feel very secure. I still love it. I'm going to stay here for the long term. Others are already looking into alternatives. So I think some impact should be expected. How much we have to wait and see. But ultimately, these are great economies, great places to live, and very market friendly. So my hope is, because I really love those regions, is that they
And
rebound.
they serve, I mean, is there, I mean, there's lifestyle, there's tax incentives, there's other things that make that the Gulf has emerged for multiple different reasons.
Yeah.
But what about the proximity, the physical time zone, the proximity to physical markets, trading physical oil and commodities in general? Does that add weight to the argument of
Yeah,
sustainability?
it's a great time zone. It's close to, you can talk like just being here in Geneva, in Zug in Geneva is a great place to be for commodities trading, being there as well, right? Closer to the production. So there is a big impact from that. That's for certain. For
Because
certain.
I know when we were at the summit in Lausanne recently, there was that realization from the hedge funds that you still have to have that last mile of connectivity that the physical traders still have a great advantage of, that knowledge, that relationships, which come from that sort of physical proximity as compared to the paper trading at a distance.
Absolutely. Like here, our strategy is very boots on the ground. This is the core of what we do. We need to be close to what is happening in production and consumption. These are physical markets. They are not, I know there is a lot of systematic fund and they perform well, but at the end of the day, these are physical markets that will be defined by how much needs to be produced at all costs, and what is the inventory cycle and the purchasing cycle. So being close to the reality on the ground is crucial, more now than ever that you see these disruptions. So why, for example, we have a different view of oil than the street is because we know how long it will take for all these challenges to be tackled, and how hard it is to take the decision to turn back an asset. Is extremely expensive. It's not that it's not as straightforward as other people that are not connected to the reality on the ground might see. So now more than ever, you need to understand the challenges of operating in that region, challenges of operating technologies that are changing, and what you can expect that comes out from there.
Well, Aline, I could talk to you all day, and hopefully we will have other times to do so. We have our annual forum every year in October in Fujairah, the Energy Markets Forum. We're going to have the 14th edition this year, and we certainly will be sending you an invitation. Hopefully you can fit it in your calendar. But Aline Carnizelo, Managing Partner at Frontier Commodities, thank you so much for your
Thank you so
time
much.
today.
A pleasure.